Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, March 11th. I'm Jay Gragnani.
And I'm Ben Jones.
Another way to say today's date is 3/11 for all of you 3/11 fans out there.
A lot of things are mixed up right now.
A lot of things are mixed up right now. So might as well jump right in it.
Yeah.
And, this week has been, nothing short of setting records in a number of different ways. Kicking the week off March 9th, the S&P 500 closed down over 7%, 7.6%. And it was the worst day, just from a market performance standpoint, the worst day that we've seen since the October of '08 time period. Dow Jones was down more than 2,000 points. And you go and you look at that day, and that in and of itself was tough. But it wasn't just the indexes. You look across the board, and there was tons of stocks. As a matter of fact, over 1,600 stocks on the New York Stock Exchange hit new 52-week lows during that day alone, during March 9th. And, that on the surface doesn't seem out of line, but when you go and you look at that number relative to historical numbers, the last time we saw a reading any higher than that was 2008. And so that number of 1,615 stocks on March 9th was the sixth highest reading of all time since we have data on this. And the five above it were all days in 2008. And 2008 obviously was a terrible market, but by the time we got to October of '08, that Lehman had already happened. The market was 40-some odd percent off of its all-time highs. We hadn't hit the bottom, quite yet during, when we saw some of that. But we're sitting here, and Monday's day, March 9th, and we're not even 20% off of the S&P 500 highs. And so it's, that I think speaks volumes to just the speed at which this pullback, this correction, this, elevated level of volatility has seen here recently.
Yeah, you're absolutely spot on. I think velocity is a good way to describe what we've seen. Let's just take a step back and look at the past, 7 days and just look at average return data. The average small cap fund, again, this is, index, so it's, passive as well as active, is down almost 10%, so 9.28%.
Wow. 7 days.
7 days, right? Small cap, certainly been impacted. Heavy in the energy space. It's one of the sectors. Financials, down 9%. Year to date, it's almost in bear market territory. Average small cap funds down 19.25%. But it's not just contained and localized in any given sector or any given asset class. It has been market wide. It's very similar to what you see in these styles of corrections where correlations basically go to one and it's everyone's selling. Look at commodities, down about 7% on average the past 7 days. Certainly being impacted by the drop in crude oil prices because of what's going on between Russia and Saudi Arabia and just global demand. The average commodities fund is almost down 15% for the year in 2020. And here's the kicker: the average S&P 500 index, equal weighted index fund and active fund, down about 6% the last 7 days. So there's really been nowhere to hide. The only positive groups that we have on our system, on the macro groups, which the ones that we typically focus on, what asset allocators utilize, it's inverse market. So unless you can short the market, which is up 10% on average, and then cash. T-bills, right? The money market is basically flat. Managed futures have done their job, so it's been this style of correction. So if you've been able to utilize some managed futures in your portfolio, you've been able to do well on a relative basis. Corporate high yield has been in the focus with everything going on in energy. We've seen the spreads widen, but the average corporate high yield bond fund kind of junk is only down about 3.8% over the past 7 days, which in bond terms is severe.
Yeah.
But I think it's a positive. At least it's better than expected. So Jay, that's kind of what we're seeing on the performance spectrum. It certainly doesn't feel good. It doesn't look good. But like what you're saying, when you look at the data, you look at the indicators. It looks a little bit like the market is trying to find that bottom. Yeah. Certainly, we don't know when or where or how that will occur, but you look at the data, it's kind of what it's beginning to look like. The market is trying to find that.
Yeah, and that's one of the times. So Monday's day obviously came on the heels of news over the weekend with crude oil, with Russia, with Saudi Arabia, with OPEC, all of that kind of good stuff. That news coming out, sent the markets into a frenzy. Not unlike August of 2011, when over the weekend the U.S. credit rating all of a sudden got downgraded, and then the market opened down Monday, pretty big as well, over 6% during that day. And when you go back to that 2011 time period, where you saw the August sell-off, and then basically for the next couple of months you saw the market chop around a little bit, and you tend to see greater volatility during these time periods where we get indicators, some of the trending indicators down in the lower levels. But that Monday, March 9th, was right smack in the middle of this 15-day period that we've been on since the market was at new all-time highs.
Right.
And so that's 15. So today, Wednesday the 11th, as we're recording this, is the 15th trading day since the market hit a high, and that was on February the 19th. The S&P 500 closed at a new all-time high. And so over the next 15 days, 12 of those have been days where the market was either up or down 1%.
Right.
And 9 of those days were days when the market was up or down 3%. That stretch and the speed and the frequency of that, obviously you've got your down 7.6% day in there, but there was multiple 3+% down days. There was a 4% down day. And so and today, right now we're certainly down more than that 3% level. And so again, going back to that, this one is different than others, although when you go back and you look at 2011, 2016 were the more recent corrections that we've seen in this longer-term bull market that we've been in. This one certainly feels different because of the speed and the velocity that it's seen.
Yeah, I mean, you're absolutely right. I mean, if you take a picture of that stat, they should put it like Webster's dictionary for the definition of volatility,
Yeah.
right? But you think about that August 2011. U.S. is getting downgraded, fears of recession. That sell-off lasted, early August and basically to mid-October.
Yeah.
What's interesting is you see these tendencies for the indicators. Let's say, for instance, the positive trend indicator for the New York Stock Exchange. So a universe that's full of small cap, a universe that's full of financials and heavy on energy. Back in that correction in 2011, that indicator bottomed around 28%. So only 28% of that universe managed to stay in a positive trend. If you go to that 2001, 2002, post 9/11 time period, it bottomed at that level as well. You look at that 2016 correction, 2018, so December 2018, the most recent one, and now March of 2020. It broke through that 28% level, but it's been hovering at 26%. That seems to be a level that kind of feels right for these styles of corrections. And so kind of your point about this time is certainly different, speed, velocity, but it does look similar in some regards to other previous corrections and even to some cases bear markets. I think what to look out for if this is different, if you continue to see more, these indicators move lower. I mean, that's when you start to get into that October 2008 time period that you mentioned, post-Lehman. That was really the only time period with this indicator going back to 1997 that it really got below 26% was that 2008 period. Now, again, I don't want to throw out these hyperboles, but when you look at the charts, I mean, that's the only kind of period that you see that particular indicator got that washed out. If we look at PT-SPX, again, these are longer term indicators that are in O's and defensive as more stocks in these respective universes have moved to negative trends. That particular indicator, I think we mentioned Monday, kind of dropped below 50%. But the importance there is that it at least gives us a framework to work within where we know that, hey, when we're at these levels, volatility is going to be higher, right? Some of the research that, Pat Wolf and their index research team has done, as well as, some of the applied research analysts here in Richmond, you see this indicator get below 50%, you typically see about 2 times the volatility for the S&P 500, right? We've been here before, though. You think 2018, you think 2016, you think 2011. So I think those out there that, just expect continued volatility until we start to see this particular indicator, improve and stabilize.
Yeah. Yeah, certainly watching for reversals up, and those are certainly some questions that we're getting is, okay, what things can we look at to try and identify when this market might have bottomed. We're looking, and as of right now, the S&P 500, if you just look at that index, 2740 is a pretty good area of support right there in the 2730, 2740 area. So it'll be nice. We've held that level 3 times basically over the course of the past year. We'll see if that holds now. You mentioned PT charts. Those are certainly something to watch out for. Another indicator that we look at is a little bit shorter term. Is called the NYSE high-low, and that is looking at basically the percent of stocks that are hitting new highs relative to those that are hitting highs and lows. And so the more we see more stocks hitting new lows, the further this indicator falls, or the fewer stocks hitting new highs, the further that indicator falls. Nonetheless, we look at it now, and it's at 8%. And what that historically has meant was anything below 10% has historically been a very, very washed out time condition. This is only the 26th time going back into the 80s since this indicator's been below 10%. Wow. So it doesn't happen often. We got back there in December of last year, or excuse me, December of 18, which shouldn't be too surprising. We also got back there in the February 2016 time period. 2011, 2009, 2008, obviously, again, all time periods where markets have gotten a bit volatile, have ultimately ended up bottoming out. But one of the things that has historically been important is not trying to identify when this is going to bottom. It's at 8% now. It could go to 2%. When you go back and you look the actual reading in the low during the December 18 time period, it got to below 1%, the actual reading on that. So we're at 8% right now. This might be, we will likely see it go lower today as the market's down. There's another 700 stocks hitting new lows today, so would likely see it down. But what you can do is set an alert for a reversal up. Reversal up from these indicators, from these such washed out levels have historically provided decent entry points into at least identifying an initial bottom. Yeah. And whether we reverse up and then ultimately come down and retest, we'll have to see that. But that's something, if you're looking for something to provide a bit of confirmation that this market has seen at least a near-term bottom, that's been historically a really good indicator to look at.
Yeah, and looking at that and talking about all these other indicators, it's why do we use these, right? And I think we had kind of a morning call this earlier today, and at these times I'm always reminded by a quote by Jim Yates, right, who developed the implied momentum bell curve, the option spectrum. Tom Dorsey, utilizes research, early on at Dorsey Wright as well as at his wheat first days. Yeah. And one reason why we still use that curve because it works, and his research, still impacts us today. But he always said that these indicators are not predictive, right? They're not going to tell you kind of what's going to happen tomorrow in the future. They're just telling you what's happening right now, where we are, and you kind of treat them like a map, right? Here's where we are, and when we look at them today, we're in defensive mode, and we're reaching some deep oversold levels. And so what does this mean, right? So if you know where you're on the map, you kind of, hey, this is kind of where I need to go, and so where I need to go, what strategies do I run? And so take a look at the playbook, right? When we're in these levels, and it typically applies to the bullish percent, when we're at this green zone below 30%, there are some kind of strategies to look at. I think for one, if you set that alert on the high low and you're looking to maybe dip your toes back into the market on a reverse up through 10%, make sure that you have a shopping list of ideas right now. That's one of the ideas that we put in the playbook. When we're at these levels, build a shopping list. It's not saying go out and buy right now, but be prepared if things do improve. Use option stops on puts, right? So if you have some profitable put positions right now and you want to, potentially, allow those to run, maybe shift from a price stop to an option price stop. So, those are some things to consider. And so, the playbook can be found at the resources page for, anyone who, subscribes to Dorsey Wright. But, again, it's just these indicators are telling us where we are. And most of them are basically saying the same thing on the pure stock indicators, right? If you look at, going from short-term indicators to long-term, they're all in O's, and they're all beginning to move to deep oversold levels.
Yeah. You're absolutely right. I mean, a lot of these things are as washed out, oversold, low, however you want to call them, since other market bottoms, 08, 16, 18, those types of time periods. And so having some of that perspective, I think, is useful. I think is helpful, especially right now in a market that seems to just be reacting to news and obviously fear rightfully or wrongfully so. That's the reality that we have to operate in, and the reality that we have to work with. And so through the indicators, through the reports, through these podcasts, we try and keep you as up to date as we can in terms of things that we see going on in the market, things that are worth paying attention to. And so with that said, we, as always, appreciate you joining us this week, and good luck to everybody out there. Stay safe, not only with the markets, but with all of the virus stuff that's spreading around.
Well said.
I know it seems to be ramping up here. I say, schools closing and events being canceled and the like. So, stay safe, be healthy, and we'll talk to you next week.